This is an Uncovered Japan Company research report on Lacto Japan, ticker 3139. Lacto Japan is Japan's leading independent importer of dairy ingredients, cheese, meat, and functional protein. The investment debate is whether its global sourcing network and move into Asian cheese manufacturing can justify more than a trader's valuation, despite a working capital-heavy balance sheet. At the report's reference price, Lacto Japan traded at about 9.7 times forward earnings, with a 3.93% dividend yield. Fiscal 2025 return on equity was 14.4%, and operating profit reached 5.95 billion yen. But the next year is an investment phase trough, so the quality and path of earnings matter more than a single headline multiple. The product is a specialist sourcing and supply chain service. Lacto audits overseas producers, contracts supply and customer demand at roughly the same time, hedges foreign exchange, and delivers ingredients to food makers. That makes the normal earnings engine a spread, rather than a bet on dairy prices. The important upgrade is vertical integration. In Thailand, Indonesia, and Singapore, the company also turns sourced ingredients into finished cheese for Asian customers. The portfolio has four parts. Dairy ingredients and cheese are almost 65% of sales and form the mature core. Asia, including owned cheese manufacturing, is 17.4%. Meat provides another diversifying leg. Life science, which supplies functional and protein ingredients, was only 5.2% of sales, but grew 86.6% in fiscal 2025. The strategy is to reinvest the core's cash into the higher value, faster growing pieces. Revenue rose from 110.9 billion yen in fiscal 2021 to 182.8 billion in fiscal 2025. But revenue is affected by commodity prices and foreign exchange, so it is not the cleanest demand signal. More important, operating profit compounded at about 20.8% a year, and operating margin reached 3.25%. Mix, functional ingredients, and own cheese manufacturing drove that improvement. The operating trend is steadier than net income. Fiscal 2025 included a 650 million yen one-off compensation gain, which will not recur. At the same time, the new Singapore plant and a core IT system bring about 450 million yen of additional depreciation in fiscal 2026. That is why the report treats the coming profit decline as a planned investment trough, rather than assuming the underlying trading business has suddenly deteriorated. Lacto has a trader's balance sheet. Inventory and receivables do the work that factory assets might do elsewhere. Fiscal 2025 inventory was about 46 billion yen, while interest-bearing debt was about 41% of total assets. The equity ratio was 35.9%. Management aims to keep the ratio above 30%, and the research expects it to improve over the plan, but rising rates and working capital swings remain real risks. Lacto's defensibility is practical rather than flashy. Independence lets it match suppliers and customers without a group affiliation. 3 decades of producer relationships, food safety checks, and customer-level formulation knowledge raise switching costs. Contracting and currency hedging protect the spread, while Asian manufacturing adds value. The constraints are just as important. Operating margins remain thin, inventory consumes cash, and a smaller balance sheet cannot match the major trading houses' firepower. Management's next LJ 2028 plan targets roughly 210 billion yen of revenue and 6 billion yen of ordinary profit by fiscal 2028. The crucial lever is the new Singapore cheese factory, which lifts Asian manufacturing capacity to 2.5 times its previous level. If it ramps well, it can lift mix and margins. If volumes disappoint, the same fixed depreciation becomes a drag. That factory is the report's clearest execution variable. The valuation is inexpensive relative to the wholesale sector, but it is not a dramatic discount to Lacto's own history. The forward PE was about 9.7 times, close to the 5-year average of 9.5 times, versus roughly 14.3 times for the TSE prime wholesale sector. The sharper tension is price to book. The shares were near 1.04 times book value, despite a fiscal 2025 return on equity of 14.4%, though that return includes a one-off boost. The report's own scenario analysis is a range, not a price target or recommendation. Its base case reaches about 4,141 yen by fiscal 2028, around 23% above the reference price, if earnings recover and the valuation holds near its historical average. The bear case falls 46% if the cycle, currency, and factory ramp all turn against the company. The bull case needs both a strong plant ramp and a better quality multiple. The balanced conclusion is that Lacto Japan has a differentiated independent sourcing network, credible margin improvement levers, and a progressive dividend policy. It also has thin structural margins, working capital needs, and rate sensitivity that the market is right to notice. The next evidence is public and specific: gross margin, the Singapore ramp, cash conversion, and whether the elevated margin buying overhang keeps easing. Use those markers to form your own view. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or recommendation to buy or sell any security. Always do your own research.